Hello, I'm Natalie MacDonald, and you're joining me in Sydney, Australia for today's Sydney Direct, where we take a look at some of the issues impacting Australian financial markets. Now, as the Reserve Bank continues to talk that Aussie dollar lower, a report by BIS Shrapnel suggests that even at 70 US cents, the Australian economy still can't return to competitiveness. Well, I caught up with Chief Economist Frank Gelber for more on this. Frank Gelber, thank you very much for taking the time to chat to Dukascopy TV today. Much appreciated.
Thanks, Natalie.
Okay, so the BIS Shrapnel report has highlighted that the Aussie dollar is really the main source of Australian economic competitiveness. Firstly, can you just expand on that a little bit for us?
Well, people tend to concentrate on things like productivity growth or our wages are too high. And I'd say, well, compared to what? Competitiveness is about your cost structure compared with overseas, and those other factors, while important, are totally swamped by movements in the currency.
Now, BlackRock have forecasted that the Aussie dollar could be at 70 US cents by year end, something which you're saying may not actually even be low enough to boost that competitiveness. Realistically, where do we actually need to see the Aussie dollar sitting to really support growth?
So we think that it needs to be between 58 and 70 cents for competitive domestic trade exposed industries on average. Now, that's a very wide range, but it actually reflects the different break-evens of the different sorts of industries. So even at 77 cents, that's now tourism, education services have already started to pick up. And they've got a lot further to go, and the lower the dollar, the better they'll be. But other industry sectors also will be affected by the lower dollar. Things like agriculture, parts of mining that are not picked up or weren't picked up during the boom, even manufacturing. Some parts of manufacturing should come back to Australia, but we're a little worried that it won't go low enough.
Some sectors, though, that the report highlights would sort of boost would be tourism, education services. Given that we are looking for that sort of shift away from mining-led investment to really forego that dip in commodity prices that we've seen, would those sectors be enough to promote some level of growth in the Australian economy?
Well, of course they would. See, during the mining boom, the dollar went up dramatically from, I think it was about 50 cents US at the beginning of last decade to well over parity with the US dollar. And so the trade exposed industries weren't competitive. They were flat to falling through the whole period of the mining boom, where we shifted our resources towards servicing high levels of mining investment at the expense of the trade exposed industries. And that was the great forgotten thing in Australia. And so now we're reversing that process. With the end of the mining boom, the dollar's coming down, and that's already starting to hit the trade exposed industries in the sense that they're starting to become competitive again. It's got a little further to go. And if you think about the Australian economy now, before the mining boom, we were in a strong, balanced growth path. When the mining boom came along, we dropped everything and went for the money, the mining. Well, that's the way capitalism works. And so we did that at the expense of balance. Now we're transitioning back to a balanced economy. But of course, there's a lot of problems in doing that transition. And so the economy's soft in the interim. And at the moment, we're experiencing weak investment and a weak economy, not falling, not in danger of recession, but tracking at around about 2.5%, maybe 3% growth if we're lucky, whereas we should be growing at 3.5% given our population growth. And that's the sort of norm that we tend to talk about. And so we've got a weak economy in the transition until the non-mining industries come back again. We know the shape in which they'll come back. The first ones that will be stimulated are actually the trade exposed industries, our export and import competing industries on the back of the lower dollar. They're going to flow on to other industry, other non-mining parts of industry. And the investment that's generated in those industries will also transition. So about 2 years from now, we'll start to see an absorption of the excess capacity that's currently in the non-mining sectors, leading to a bit of momentum in investment. So we already know the route by which the Australian economy will recover. In the short term, it's soft. It stays soft for another 2 years before we pick up momentum. But remember, there's enormous cyclical and structural changes going on in the Australian economy through this period. And we come in towards the end of the decade performing very strongly.
How then does all of this shape your forecast then for how the RBA may look to sort of create supportive policy or promote this along over the mid to long term period?
So the Reserve Bank has a constrained game to play. We're at the stage now where the weakness of investment has nothing to do with interest rates. It's more to do with the fact that in the non-mining sectors, demand is weak, profitability is weak, there's still excess capacity in the system. And so the thing that will change that is stronger demand, stronger profitability, and less excess capacity. And that will come naturally as the non-mining sectors start to recover. But business isn't ready to invest yet. So there's no point reducing interest rates to try to stimulate investment. The economists say it's like pushing on a piece of string. You really need to wait until people are ready for investment, and then they'll want to borrow money to invest, but it's not yet. So first we need to go through other things. So it doesn't make a lot of sense for the Reserve Bank to reduce interest rates any further, though they could. They may try to weaken the dollar a little bit further, but that's not particularly successful in this sort of environment. I think the more important question is when they start to raise interest rates. And the real issue is, so what happens when overseas cash rates rise? So the Fed is on the threshold of a rise. Is it this month or next month or early next year? Well, I'm not sure. But when they do raise interest rates, do Australian rates follow? The answer is no. And the reason is there's a big buffer between Australian and overseas rates. And that will allow the Reserve Bank to run its interest rates on domestic policy issues. And in a weak economy with weak inflationary pressure, they'll keep interest rates low for another few years before they start to rise again.
Frank, thank you so much for taking the time to chat with us today. Much appreciated.
It's a pleasure.
For more on this FX analysis and for exclusive interviews, do stay tuned to Dukascopy TV. For now, though, it's goodbye.